Okay, hello ladies and gentlemen, and welcome to this webinar brought to you by City Index. My name is James Chen. I'm the Chief Technical Strategist with City Index Group. Today we're going to be talking about using multiple time frames when analyzing charts. Now this webinar is part of our ongoing Wednesday evening, or Wednesday evening for most of you, but not so evening here where I am in the U.S. But Wednesday evening at 8 o'clock London time, these webinars are all about educational aspects of trading in the financial markets. So again, we're going to be talking about using multiple time frames when analyzing charts. And there's a pretty big group here, and I see a lot of questions. I'll try to get to them, as many of these questions as I can towards the end of this presentation. But just to answer a few of these questions here regarding whether this is going to be recorded or not, yes, it is. It will be recorded, just as all of our webinars are recorded, and they are posted on our website on our archives page. So please go take a look there. This webinar will probably be posted by tomorrow afternoon or so. So feel free to go take a look at it there. Okay, so let's get started real quick. Before we get started, just a quick disclaimer. Financial trading carries a high level of risk to your capital with a possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Okay. Okay. So let's move on real quick. For those of you who are not familiar with who I am or what I do, again, my name is James Chen. I'm the Chief Technical Strategist with City Index Group, which means basically what I do is I trade on a daily basis. I analyze markets and I educate, much like what I'm doing now. And this is, I think a lot of you are familiar with me, so I'm not going to go through all of this. But basically, I've been trading for a long time, and I do a lot of these webinars with City Index Group, and also my analysis you could find on our website at cityindex.co.uk under the Market Analysis section. Okay, before I get there, let me just address a couple of these questions. Your opinion of the FOMC minutes, the Fed interest rate, and Yellen. Well, all I could say was that, technical traders like me are very price action based. All I could say was there was a huge move, and for me it was very good. There was a huge move in the U.S. Stock indices, as well as a lot of individual stocks, as well as gold, and also crude oil jumped up. So I'm glad about a lot of those. But essentially, yeah, I mean, right after it came out, there was a big jump in most of the markets that I was looking at, which was a very welcome thing there. So you never know what to expect with the markets. That's why I trade. I don't trade off of news. I do trade based upon technicals as well as fundamentals. If you try trading upon news, what happened today with the FOMC meeting in the U.S. It could have gone either way. It could have gone just as easily gone the opposite way. So that's why it's very difficult to trade based upon the news. But that being said, let me just quickly go over some of these questions here. Hassan says, I need to become a professional forex trader. I would like to know how I could become a student of City Index. Well, we provide education on an ongoing basis here, so you don't have to pay for that. It's all here for you. Is my last webinar available anywhere? Yes, it's on our archives page on our website. Okay, I think I've gotten some of the preliminary questions. Okay, so in terms of the educational webinars, again, it's the Wednesday ongoing webinar series. The first week we talked about an intro to trading, the different markets, and then I talked about the best indicators for technical trading. Last week I talked about the most common chart patterns. You could go ahead, if you missed that, you could take a look on our website at the recording. I talked about all different types of chart patterns and how I use them. Today, once again, I'm going to be talking about multiple time frames when analyzing charts, which is a very interesting topic, and I think you'll find this very interesting and useful. It's a little bit more advanced than the other stuff I've been talking about, but we'll get to that in a moment. Next week I'm going to be talking about planning high probability trade entries, and then the week after I'm going to be talking about setting stop losses and profit targets very, very important. And then I'm going to be talking about emotions and trading psychology, something that a lot of traders tend to overlook, and they really shouldn't, and I'm going to be talking all about that. And then we're going to be talking about discipline, which is probably among the most important aspects of your trading. Forget about everything else. If you have the discipline and if you have a halfway decent strategy, then you've won most of the game right there. So that's the first 8 weeks. Again, I said this was an ongoing webinar series, so I just don't have the subjects or the topics for the next weeks after these 8 weeks, but rest assured we will keep going with this with all kinds of different topics because there is so much to cover within this space, the trading space. Okay, so let's move forward real quick. Let's talk about multiple time frame trading. Again, if you have any questions, please feel free to type them into the questions window. So what is multiple time frame trading? Well, let's start from the very beginning. What is a time frame? I'm going to go over this very quickly, but I have to go over it because for those of you who are beginners, a lot of people might not understand what I'm saying if I don't go over the very, very simple basics. I know a lot of you who've been trading a long time might get impatient with it, but please bear with me. I'm going to get to the other stuff in a minute. But let me just talk about time frames. What is a time frame? Well, a time frame is basically when you look on a chart, it's either a bar or a candlestick, and that represents a certain space of time. Okay, so a time frame is basically the duration of each bar or candlestick. Now, if you take a look at a bar or candlestick, you see, you take a look at a bar, okay? So you could use either on our charts. You could either use bars or candlesticks or whatever you want to use, but basically bars and candlesticks are pretty much exactly the same thing in terms of the information they provide you. The open price of that period, the close price of that period, and the high and low of that period. Okay, so it's very, very simple. Candlestick is exactly the same information, just represented in a slightly different way. I'm not going to go over the differences here because I think most of you know what it is, what they are. But basically, each of these bars or candlesticks represents a certain period of time, whether it be a day, an hour, 5 minutes, 1 minute, a year, or what have you. We don't have a yearly, but I think the most we go up to is a monthly. But, in terms of these bars and candlesticks, that's what they represent, the duration of each duration of time. So each bar or candlestick will represent the time between the open and the close of the bar or candlestick. So between the open, if you take a look at this bar here, between the open where it starts on the left and then where it closes on the right, and it goes up, it goes down, it goes down, it goes up, it hits a high, it hits a low, it hits a low, it hits a high, and then it ends up. That represents the span of 5 minutes on a 5-minute chart, or it represents a span of 1 hour on a 1-hour chart, okay? Let me show you real quick. If you take a look at this chart here I have of the euro dollar, this is a 4-hour chart. I'm going to show you this strategy in a moment. But if you take a look at, let's say, this bar right here, this red bar right here, that means within this 4-hour period, price went down. It was a bearish bar. So it opened at the top of this bar. It closed at the bottom of this bar. Okay, and then in between that time, it went to a high. It went to a low. Okay, in this case, the low was the same as its close. So as we can see here, this is a time frame. This is the 4-hour time frame. Okay, so that out of the way, this again, there's the same price information on all the different time frames. So whether you look at a 4-hour time frame or a 1-hour time frame or a 15-minute time frame or one day time frame or whatever you want to look at, the price information is going to be the same. The current price is going to be the same. It's just that price is cut up differently over time on the different time frames. Hopefully that makes some sense. Okay, so I'm going to get to which moving averages I'm using on that chart because I'm going to be looking at that chart and talking about it in a minute. But again, this same price information on all different time frames, but there may be different trends. And what do I mean by that? Okay, so let's look at time frame trend differences. Now this is on the same chart, okay, the same market, okay, whether it be Apple stock or it be the FTSE 100 or the euro dollar or gold or crude oil or what have you, okay? This could be what it looks like on the daily chart if you take a look here, okay? So we see a nice uptrend on the daily chart. And then we drill down to the 1 hour chart and we see a nice, sort of falling chart here, okay? And this is the same during the same time, okay? So this daily chart is showing a bunch of days. This hourly chart is showing a bunch of hours, okay? Within a certain day or within a certain several days. And then the 5-minute chart is showing sort of consolidation or a slight up move, okay? And you could have this occurring at the same exact time. Now, what do? So, that's why it's so important to look at different time frames. You see that the daily chart is very bullish. It's going up. You see the 1 hour chart is pretty much going down. And you see the 5-minute chart is going up. So what do at that point? Well, if you're looking at the daily chart, you're probably going to think this is bullish, so I'm going to go long. If you're looking at the 1 hour chart, you're thinking this is pretty bearish. And if you're looking at the 5-minute chart, you're thinking, this might be a good short-term buy or what have you. But if you look at all 3 different time frames at the same time, then I would argue that you have a higher probability opportunity to trade. And why is that? Well, what I look for amongst all the different time frames is what's called agreement. Okay, agreement. Okay, so before we get to what that agreement is, first of all, if we have a daily chart that's going up, that's showing a clear uptrend, if we have a 1 hour chart that's showing a clear downtrend, and then a 5-minute chart that's showing a slight uptrend but sort of going up and down, if I'm trading based upon these 3 different time frames simultaneously, I'm thinking I'm getting conflicting signals, and therefore it's not for me a strong trade, okay? And I'm going to show you what is a strong trade when looking at different time frames in a minute. I'll show you that in a minute. Okay. Now, I wanted to show you this. I know I show this a lot, and for those of you who have seen this before, please bear with me, but it bears mentioning again because of the fact that when I'm trading on different time frames, when I'm using several different time frames, usually it's 3 different time frames simultaneously, what I'm going to be doing is I'm going to be looking for opportunities to trade with the trend, and therefore I'm going to be using my market principle, which I've coined as TPB, or trend pullback breakout. Now, what is this? It's a very, very simple principle, okay? A simple theory, simple principle, but it underlies almost all of the strategies that I use to trade in almost all the markets that I trade in, okay? So if you've heard it before, I apologize, but this is, really what underlies all my trading, and this is going to apply to the multiple time frame trading very, very well. Okay, so what is TPB very quickly? TPB is simply we want to identify the trend, whether the trend is up or down. We want to watch for a pullback, okay? And then we want to watch for a breakout back in the direction of the trend. Now, if you think about this from a multiple time frame perspective, what is this that you're looking at? You're looking at the trend on the longest term time frame. You're looking for a pullback on the middle time frame, and then you're looking for a breakout on the shortest term time frame. What does that mean? Why are you looking at a breakout on the shortest term time frame? Because you're looking at the momentum of the short term momentum to agree with the overall trend and to agree with a recovery of the pullback. I hope I'm making sense here. For those of you who haven't heard me before, this may not make a lot of sense, but bear with me because I'm going to show you exactly how it works. Now, again, okay, I'm going to get to that question in a second, Paul. But again, you have the trend, you have a pullback, but not only am I looking for a pullback, I'm looking for a recovery of the pullback on the middle time frame, and then I'm looking for a breakout in the direction of the trend. Okay, now Paul. Paul says, the problem I have found is that even in a trend, you get some news that comes out and stops you out even though you're in a trend. Okay, absolutely. Okay, so this happens all the time. What I generally say is that I generally like to avoid news when I can. Okay, when you're in a longer term position, oftentimes you cannot. But I try my best to to frame my trades around news. For example, away from news like what happened today with the FOMC meeting and that big move in the markets. But that being said, that cannot be helped if you are in a longer-term trade and you have news that that takes you out. That's what your risk management is for. Okay, so if you're trading with a trend, if you identified a pullback and then a recovery of a pullback, if you played the breakout, okay, and then shortly after that breakout, some news, whether it's scheduled or unscheduled news, goes against your position, takes you out, that's part of the game. Okay, so there's nothing more I could say about that other than try your best to avoid the news if you're trading from a technical perspective. But if you're stuck within a trade during news, then that's when your risk management should definitely take care of you, and that's why risk management is such a huge part of trading. Okay, so that's my market principle trend pullback breakout. Okay, now let's talk about the time frames. Now, in terms of time frames, first of all, multiple time frames, first of all, what I'm going to do is I'm going to give you the general principle behind it, okay? And then I'm going to give you a little bit of a more concrete strategy that I often use, and then I'm going to show you my charts. But basically, what I don't want you to take away from this is that there is one way to trade this. Okay, there's not one way to trade multiple time frames. There are many ways to trade multiple time frames. The important aspect of trading with multiple time frames is that you see the picture, the market picture from different perspectives, and then you find agreement amongst those perspectives, and then you trade, when there is agreement, and then you have a higher probability trade. Okay, can you guys hear me? Someone says the sound is gone. If you could hear me, please say yes. Okay. Okay, great. I'm not sure why your sound may be gone, but looks like everyone else is okay. Let me see. What is the best way? Okay, I'm going to get to all of this. James, what is the best way of identifying the trend? I'm going to get to that in a minute. Paul, yeah, not sure what that refers to, but Ludovico, barring support and resistance levels, how do you identify breakout levels? It's mostly through support and resistance, okay, Ludovico. It is support and resistance that I'm looking for. I'm looking for breakouts. But in this particular strategy that I'm going to show you, I'm talking more about a break of the prior candle, which is also sort of support and resistance. So it all really comes back to support and resistance in the end. Okay. Okay, great. Great. Okay, so let's get back to multiple time frame trading. So again, the main point here is not to take some strategy and think that it's going to be the holy grail. The main thing here is to take this approach, which is looking at different perspectives in the market, looking for agreement amongst those perspectives, and then using that agreement to find the highest probability trades possible. And that's really what you should take from this. But that being said, let's move forward. Okay. So the concept, what is the concept? Again, different time frames will often have different trends, as we just saw. Okay. Now, what we want to do is we want to seek agreement or confluence among those time frames. Okay. So we want to seek agreement among different time frames. Once we see agreement among them, or confluence simply means confirmations or coming together of your different tools. If I talk a lot about support. Let's say support and resistance, and then if it's also where moving averages, it's also where a Fibonacci level is, et cetera. If it's all coming together, that's called confluence. Same thing with time frames. If it's all coming together, if they're all saying, the three different time frames are all saying the same thing, then perhaps this is going in the direction that you think it's going. And then you could put in your trade, and then if it's not, or if it's a false signal, then you have your risk management to take care of you, okay? So it's very, very simple in that respect. Okay, so number one, we first look at the big picture for the prevailing trend. And for that, we're going to be looking at the long-term time frame. Okay? So again, we look at the long-term time frame for the big picture of where the market is, where the market is trending, whether it's trending strongly up, strongly down, or what have you, okay? Despite that move in the euro dollar today, that moved to the upside, the euro dollar is still very much within a downtrend, okay, and will continue to be so until it's not. Okay, so that, I mean, it's very simple. Until it's not, which means until it starts showing signs of a reversal. But at this point, the euro dollar is very, very much in a downtrend, much like the indices. All the indices, pretty much, are all in uptrends. Okay, so we want to look at the big picture for the prevailing trend, and then once we have the big picture, then we drill down to get a closer look at any potential pullback. Okay, with the middle term time frame. So, what is a pullback? It is a counter-trend move. It is a move within a trend that moves against the trend. And there may be many different reasons for that pullback. One very important reason would be profit taking. Okay, so let's say you have a stock that's moving up and up and up, and it keeps going up, and it's a very strong uptrend. Okay, it's got to pull back at some point because there's got to be some type of profit taking. Or it could be some negative news or what have you, but there will always be pullbacks, and that's what we're looking for to get into the trend, okay? So we have the very strong uptrend, let's say, and then price action pulls back, and then we're looking for that pullback, but not only are we looking for that pullback, we're looking for a recovery of that pullback back in the direction of the trend, okay? So we have a trend, we have a pullback, then we're looking for a slight recovery where the chart, the middle term chart, is showing some indication that price action is moving back in the direction of the trend. Then finally we get very microscopic to pinpoint entries and exits on the short-term time frame. We're looking for breakouts back in the direction of the trend. Okay. Okay, let me see here. RSI is very helpful. Oftentimes, Saul, I found the RSI helpful. Bullish over 50, bearish below 50. What do you think? Yes, yeah. I mean, absolutely. A lot of people think differently. A lot of people think that if it's below 50, then it's bullish because it's oversold, or if it's above 50, then it's bearish because it's overbought. I happen to be, the opposite, just much like you, where I'm looking for recoveries from those overbought or oversold areas, and then looking for trend moves in that direction. Okay, but I did talk a lot about that a couple of webinars ago. Okay. Yeah, and a lot of people do that, Saul. You look forward to moving in the direction. A lot of people do that. RSI and stochastics and all of the oscillators can be used in that respect as trend following indicators, although a lot of people don't use it in that way. Okay, so again, we get microscopic on the short-term time frame, and we're looking for entries and exits on breakouts. So again, number one, look for the big picture on the long-term time frame. Number two, we're looking for recoveries of pullbacks on the intermediate time frame. Number three, we're looking for breakouts on the short-term time frame. Okay, now why are we using multiple time frames? Okay, why not just look at your, most of you are using short-term charts. Why not just look at your 5-minute chart or your 1-minute chart and just trade off that? Well, you could very well do that. Okay, I do that sometimes as well. But looking at 3 different time frames, looking at multiple time frames, helps me reduce false signals by filtering trade decisions through multiple time frames, okay, multiple perspectives. Okay, so yes, I mean, I could trade, I often trade off of the 1-hour chart or the half-hour chart or even the 15-minute chart, or sometimes the 4-hour chart or what have you. But if you put them together, and what I found is that you put them together, you have a much higher probability of getting a better trade because you have that agreement among the time frames, okay? So what we want to do with the multiple time frame trading is we want to trade the trend in the path of least resistance as confirmed by these multiple time frames, in this case 3. Okay, so I'm going to give you a time frame example: 4-hour, 1-hour, and 15-minute. Okay, so you could certainly use others, but this is what I often use. So 4-hour, 1-hour, and 15-minute. 4 hours in long term, where each bar or candlestick is worth 4 hours. 1 hour is the middle term, where each 1 hour is candle or bar is worth, each candle or bar is worth 1 hour, and then the short-term time frame where each candle or bar is worth 15 minutes. Okay. Now, on the 4 hour, the long term, we're going to identify the trend. Okay. If there is a trend, we look for a pullback. Okay. 4 hour chart, we identify the trend. If there's a trend, then we look for a pullback. On the 1 hour chart, if there is a pullback, we look for recovery from the pullback. Okay. And then on the shortest term time frame, the 15-minute chart, if there is a recovery from the pullback, then we look for a breakout entry in the direction of the trend once again. Okay. Now, if you think about it, this is basically trend, pullback, breakout. Okay. So you're looking for the trend on the long term. You're looking for a pullback on the 1 hour. Okay. And then you're looking for a breakout on the 15-minute. And if you think about it even more, you're going to see that what does this mean if all of these signals are lining up? It means that there is agreement among the time frames. Why is that? 4 hour time frame, let's say, is showing an uptrend. Okay? Then we see that there's a pullback on that uptrend. The 1 hour chart, we drill down to the 1 hour chart. Now we look for a recovery from the pullback. Okay? So now it's going up. It's recovering back up. If that's occurring, then we look on the shortest term time frame, and we're looking for a breakout up. Okay, so all of this is up. All of this is going long. They're all agreeing that the chart, the market is going up, and therefore I'm going to get into a trade. And I have my stop loss. I have my risk management to take care of me in case I'm wrong. Okay. Okay, Christian, is that a 4 hour, 1 hour, 15-minute for FX or indices? It's pretty much for anything you look at. Okay, so I'm just showing you examples here. I'm going to show you an example on the euro dollar just because I'm very used to trading this strategy on the euro dollar, but I've traded on many different time frames as well. I'm sorry, many different markets as well. So you could certainly try them on different markets. The principle is the same. Like I've been saying for many years. There are differences between markets. There certainly are differences between and among the different markets. However, if you take it down to the chart level, the price action level, the technical analysis level, the differences start to fade away. Okay, because of course there's still going to be differences, but in terms of the technicals, you're looking at a chart. The price action movement, the market dynamics remain the same, or not the same, but very similar, regardless of what market you're looking at. Whether you're looking at the FTSE, or you're looking at the euro dollar, or you're looking at the S&P 500 or gold, or what have you. Okay. Of course, there are different market forces moving these markets. However, price action and trading psychology remain very similar, and therefore that's why technical analysis works very well in all the markets. Okay. Let me see here. Okay. Now the question here is from Paul. Is that for an intraday trade? Okay. So I use the 4 hour. I use the 1 hour and the 15-minute. Is that for an intraday trade? Well, the thing here is that it really depends because I like to think less about how long I'm usually in a trade. Like a lot of people say, oh, I'm only in a trade for a few seconds, or I'm only in a trade for a few minutes, or I'm only in a trade for an hour, or I'm only in a trade for a day, or I'm in a trade for a week, or what have you. Okay, instead of doing that, what I generally say is I allow the market to dictate how long I'm in a trade. Okay, which means, and it's very simple, which means that the duration of time that I'm in a trade depends on whether whether that trade continues to be valid, whether my stop losses were taken out, whether my profit targets have been taken out, whether my trailing stop loss has been taken out, or what have you. Okay, so it really depends on the market. If the market keeps going up forever and I'm in a long trade, even though it started as a short-term trade, I'm probably going to be in that trade for a long time. Okay, because more likely than not, I'm going to be what do you call it? I'm going to be locking in my profits. Okay, so I'm going to be locking in my profits as the trade moves in my direction, and therefore, if I continue to do that, and if the market keeps going in my favor, I'm going to continue to do so until I get stopped out for a profit. Okay. So it really depends. It really depends, how long. Now, that being said, a 4-hour, 1 hour, and 15-minute multiple time frame trade, oftentimes is within a day that you could get out of the trade. It could extend longer than that, but usually it's within a day. Okay, there are lots of questions here. I'm going to try to get to as many as I can in a little bit. Okay, so long-term time frame. Okay, so again, this is the 4-hour time frame in this example. Now, we want to identify the trend. If there's a trend, we look for a pullback. Okay, if there's no trend, there's no trade. Okay, so you see a market. You look at the 4-hour chart of it. If there's no trend, there's no trade. Now the question comes up: how do you know if there's a trend or not? Well, you could just look at it to see if there's a trend or not, but there are other ways to do it, and one of the ways is I'm going to show you right now. I use what's called the COMA, the correct order of moving averages, okay? So to answer someone's question a little while ago, what moving averages was I using? I was using the 50, the 100, and the 200 SMAs, okay? I could very well be using others, but for this particular strategy, I've been using the 50, 100, and 200 for a long time. Okay, and you could certainly test others, but for the correct order moving averages on the long-term time frame, I'm looking for the moving averages to line up. Okay, to be in correct order. Okay, and this is exactly what I mean right here. So if you take a look here, you take a look here on the left. You see the why not an EMA instead of an SMA? Okay, why not EMA? Well, you could very well do EMA. Okay, EMA is exponential moving average. All it means is that the most recent prices are weighted more heavily than further price action further back. But basically, they're the same thing. When you use them in this manner, they're the same thing. Yes, if you use moving averages in a moving average crossover strategy, then there might be slight differences, okay? But in this particular case, the way I'm using it here, I'm using the simple moving average only because I've been using it for a long time and I've tested them across different markets and for a long time. And basically, if I were to use an EMA instead of an SMA, it would be pretty much the same thing, pretty much, okay? Anyway, so this is the correct order moving averages. So I have the 50, 100, and 200. What does that mean? On the top, I have the 50. In the middle, in blue, I have the 100. And on the bottom, I have the 200. Okay? So the shortest is on top. The middle one is in the middle. And then the longest one is on the bottom. That is the correct order of moving averages, or COMA, for an uptrend. I know it's a ridiculous, acronym there, COMA, and it doesn't really mean anything. It just happened to, fit. So we have this correct order moving averages for uptrend, so that's how I define it in that case. Am I going to be drawing trend lines? I could. Am I going to be just looking at the naked chart and seeing if it's in an uptrend? Absolutely, I could. Okay, but to make it more concrete, to make it more systematic, to make it more clear-cut, I'm using, this method, okay? I'm using this correct order moving averages. So this is a correct order moving averages for an uptrend. Downtrend, same thing but opposite. The black one is the 200 period, the blue one is the 100 period, and the red one is the 50 period. Okay, all this means is that this is in the correct order moving averages for a downtrend, with the longest one on top, the middle one in the middle, and the shortest one on the bottom. That's correct order moving averages for